Dabur, which has also come out of their numbers. Suyash, talk to us how are Dabur's numbers looking like?
Dabur's numbers are looking pretty good. In fact, it has met the street's expectation as far as profitability is concerned. However, revenue was slightly below estimates. Now, if you look at the profit figure, the profit came in at around 515 crore in the quarter gone by versus around 491 crore in the year ago period. So this is about a 5% rise on a year-on-year basis. Revenue in the previous quarter stood at 3,204 crores versus 2,986 crores. So a 7.3% increase on a year-on-year basis, but it's a slight miss. As per the street's expectation, is down by about 0.3 to 0.4% compared to what the street was expecting. Now, this was on the back of a miss on the volumes front. Street was pegging in a volume growth of about 3%. 4 to 5%. The domestic volume growth came in at about 3%. So that was a major dampener for the overall earnings, which was largely good. And if you look at the EBITDA, it jumped about 10% on a year-on-year basis, coming in at 661 crore in the September quarter versus 601 crore in the year-ago period. Margins have also improved by about 0.5% or 50 basis points, coming in at 20.6% versus 20.1% in the year-ago period.
Right, but the big concern, as you're rightly pointing out, especially when it comes to FMCG companies, isn't that the case, Suyash, that the volume growth number is what the market looks for, because that's an estimation of the amount of business that FMCG companies are doing. Are people buying enough of their soaps and enough of their fast-moving consumer goods on a regular basis? Volume growth is a crucial indicator of the consumer sentiment for FMCG products are concerned. Amit, let's quickly take this across to you. How do you view these Dabur numbers? Net profit, net sales, even the margins and EBITDA seem fine, but the fact of the matter is that the street is disappointed with with the volume figure, which is coming a full 1% lower than what they were expecting.
No, I think the numbers are pretty much consistent with what other FMCG companies have already reported, whether it is HUL, ITC, Nestle, or even Tata Consumer yesterday. There is a clear stress in the rural segment of the markets, and the volume dip which we are seeing in most FMCG companies, including Dabur, that is sort of putting a lid on the overall revenues and the profitability of these companies. My sense is that we have to see how the Rabi crops sort of pans out in over the next 3-4 months, and if there is improvement on those macroeconomic indicators, and then there is a positive consumer sentiment because of the festive season, then we'll see a sort of a gradual recovery in the rural markets. The urban market is doing well. The margins there are still as per the expectations. But I think we'll need a push from the rural side of the markets in the next 3-4 months to improve the volume growth, which has sort of seen a dip over the last 2 quarters.
Sir, talking about demand from the rural market, I was also reading the management commentary. I think the problem is two-pronged. First, the rural consumption has not really picked up, and second, at least from HUL's commentary, that small regional players and local players are eating away from the market share, at least in the tier 2, tier 3 cities. So going ahead, do you think this will be a problem for FMCG, especially the consumer staples?
Yes, the HUL commentary which you are talking about is actually pretty much consistent with what other FMCG like ITC has also said, that a lot of these D2C brands are actually eating into the pie of the established players. So people are becoming a little bit more experimental. Some sort of the shift is also because of the price discovery. People are ready to experiment at a lower cost as well. So we are seeing people, utilizing maybe a new packet of noodles or even biscuits. So that is happening. It is not so much in the rural belt, I would say, but definitely in the tier 2 and tier 3 cities that is happening. And there is a very clear trend that sort of a move is happening from the organized markets to, we cannot say unorganized market, but it is sort of very small in nature at this point of time, a lot of these D2C brands. But because they are very active on the digital mediums and digital front, and a lot of these a lot of these consumers are actually going on Instagrams, for example, or even other social media platforms. So they are getting the hits, and that is actually getting converted into sales. So my sense is this trend is very interesting from a sort of a medium to long term perspective, and we could see some players making a big dent into the revenues of the large FMCG players over the next few months. So we have to be a little watchful in that front.
We have to be watchful, so Suyash, all this talk of Dabur and competing brands, D2C brands, all that controversy around the honey that the FMCG brands
Exactly.
sell, and especially Dabur is a company known for their honey, and people's trust in whether are we even buying real honey when we buy those traditional products, or do we need to look for alternatives like the D2C alternatives that could be available, fresh honey, real honey with the bees in them. I don't know, but one way or the other, the established FMCG players are having it difficult because of this D2C brands volume growth. That's why their sales volumes are not growing. But again, it's nothing happens overnight. This is something that's building, and as Amit is talking about, we'll get to know in the medium term definitely as to how it pans out, if not the long term.